And what you'll see is their public equity component really is actually, last I saw was below 25%, and most of their allocation weighting was to private equity or private real estate, and both of those combined were well over 50% of their allocation. So again, you described it perfectly. They're kind of leaving public equity and finding better investment in the private markets.
On this episode of Early Bird, Travis Forman, Portfolio Manager of Strategic Private Wealth at Harbourfront Wealth Management. Travis joins the podcast today to talk about where the ultra-high net worth are investing, including a look at the 2023 market and how you can make the same investments as ultra-high net worth investors. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, Travis, welcome to the Early Bird podcast. How are you doing?
I'm doing great, Stephen. How are you?
I'm doing wonderful. Thank you so much. Today we're going to talk about where the ultra high net worth are investing. It's a question we get a lot from listeners of the podcast and from readers and subscribers to the newsletter. But before we get to that, Travis, let's tell the audience a little bit about your background. In about 30 seconds, how would you describe your background?
So my background is I'm the architect and portfolio manager of three private investment pools that specialize in private debt, private credit, and private debt, private real estate, and private equity. Basically where it all started, if you want to do that, I was back in 2016. We saw the headwinds on public income. And we knew that public income, when you have the headwinds on public income with rising interest rates, we knew the headwinds that has on performance. And so being a fiduciary for our clients, business owner and a partner of the firm, we had to get in front of that. And so what we did was we took a look at what the world's most prudent investors are doing. And I think it's topical for your comment today on ultra high net worth investing, because I think we can agree that the most prudent investors are, say, Harvard, Yale, Stanford, on the south of the line, and then up in Canada, the Canadian pension plans are highly regarded as some of the best run asset managers in the world. And when you start to unpack what they were doing back in the day, it's in line with the ultra high net worth community that they're largely leaving public equities and finding their solutions to meet their future obligation with private investments and ultra high net worth investment strategies.
Yeah, good point you bring up there. Last year, obviously, we saw the stock market take a pretty big drop. So public equities was a terrible year. So you're saying a lot of the ultra high net worth, they're outside of public equities. They're looking at private real estate and private equity in areas such as that, right?
You got it. There's actually, you could Google it. There's a club called the Tiger 21, which is kind of deemed to be a ultra high net worth investment community. I believe you have to be able to cash a $10 million check at any time in order to kind of be in it. And you can just Google it. They actually publish their allocation online. And what you'll see is their public equity component really is actually, last I saw was below 25%. And most of their allocation weighting was to private equity or private real estate, and both of those combined were well over 50% of their allocation. So again, you described it perfectly. They're kind of leaving public equity and finding better investment in the private markets.
Yeah, you said the club was what, 10 million you needed to get in, right?
I believe, yeah.
Yeah, I'm about $9,999,999 short of that, but that's good to know. I guess if they're leaving the public equities going into the private markets, it must be because they see the real value there. Last year, 2022, we all know how the public markets performed. How did the private markets perform last year in 2022?
Okay, so I'll break it down because the asset classes that are typically favored in the private are real estate, credit, and equity. Okay, and so I think we all know that the public income or bond market had a really tough year. Depending on the type of yield you were chasing, you were kind of negative, anywhere between say -7 and -15. And on the private credit side, not the public income, but the private credit side, typically these are asset-backed loans or collateralized loans where you're just kind of receiving yield. So you don't see the volatility that you're getting in prices on bonds. So typically on a private mortgage type investment, you would have got anywhere between quite literally 5 to 8%. And so for the income portion of that portfolio, a +5 to +8, that's significant alpha over that -7 to -14 the public markets were getting. And that's on the credit side. On the real estate side, similar events transpired. The public real estate investments had a tough time, typically, well into the double-digit negatives. And on the private real estate side, you typically still saw low double-digit positives or high single-digit positives. So, so in a nutshell, basically, those two asset classes had significant alpha over their public competitors over that same period of time.
Got it. I'm curious, those areas and those asset classes that you bring up, what impact did some of the larger macroeconomic factors play in those areas, whether it's inflation, higher interest rates, the war in Europe? Did those challenges impact those asset classes in any way last year?
They did. And I'm going to start with credit on the first, and then I'll move on to the real estate second. Okay.
Sure.
So in the private credit side, these are typically very short duration loans, typically under a year. Mm-hmm. Okay. And so therefore you don't get price compression like you do in the public income market on really short duration loans. The other thing happened is they're floating rate loans. So you hit it on the head. There's inflation. There's no secret from that. And most North Americans are feeling underwater by their increased carrying costs or interest rates. Mm-hmm. So that had, and so what happens though is these credit loans are floating rates. So they actually go up when interest rates go up. So it's kind of the opposite of what actually happens in public income. When interest rates go up, bonds typically have some price compression. When interest rates went up, the private credit actually goes up. So that was a good way, when I say to inflation-proof a person's portfolio. On the real estate side of things, using the macro figure you're saying there, same thing. Increasing interest rates obviously means you're going to have, in most cases, a reduction of operating income because of your mortgages. Your interest rates are going to get higher, and therefore you saw the public real estate react negatively because of that. But what happened in the private market is quite actually the opposite. Most of these operators have like 7 or 8 year debt that's fixed on those ultra low interest rates that we saw 2 years ago, right? And so what's happened is rent goes up with inflation, of course, but their operating expense is actually fixed on that debt from the loans that were set previous to the interest rate hikes. So what happens is you've got revenue going up, you've got operating OPEX fixed, and so therefore net operating income increases significantly. So the textbook says if interest rates go up, sell public real estate because it's going to be bad. But quite the opposite actually happened. Net operating income went up in most cases. And so therefore we saw decent returns on private real estate over the public.
Nice. Interesting to look back at last year and see how those private markets performed. So we're here in the first quarter of 2023. These private markets, how do you think they're going to perform in the current year of 2023?
Okay. So the great thing about the private market right off the top is it has a reduced correlation to the public market. Okay. We all want to high five each other sometimes or bury our heads in the sand other times with the public markets because of the volatility that comes with that. And that volatility comes a lot of the times just because you can sell or buy, right? And we can make emotional decisions and run to the keyboard and hit sell or buy based on a tweet or a news headline or what have you. In the private markets, it's not quite that simple. you can't get your money back in a second. It typically takes, upwards to 30, 60, or 90 days. And so therefore, what I say there is it eliminates irrational investor behavior. It's not that we're all irrational, we're just emotional people, and we get charged up and make decisions quickly. But you can't go hit sell in the private markets because your money doesn't come available for 30 or 60 days. So what an emotionally charged event that's triggering somebody to want to sell at a potentially a bad time, would have passed by the time the money's available in the private markets. So it actually smooths out the ride because you're eliminating that sensationalism and the emotions that come with it. So right off the bat, it's a smoother ride for people. Secondly, the higher interest rates on the credit side are favorable. Okay, it's going to continue to stay in that floating rate environment. If we see a couple more rate hikes, that's good for the credit. Okay, at the end of the day. But of course, hopefully we're all hoping that inflation's behind us. And even if it just stabilizes at this level or starts to tweeter off, and interest rate might come down, towards the second half of the year, the credit's going to have a great year. Keep in mind that private credit is always, typically in most cases, backstopped by real estate collateral, and that real estate collateral is typically, loan to value of 50%. So therefore, for every $50 lent out, they have $1 of collateral. So it's a very, very strong asset class. We expect a very stable environment there. On the private real estate side of things, I think, the big wins are kind of behind us. It's going to be a more muted return, but as whatever recessionary environment plays through and interest rates start to fall, say Q4 or Q1 2024, then that real estate will start to see an uplift there. It's more of a core holding. You can't time it perfectly. You can't buy and sell it day to day. It's more of a long-term core holding, both of these asset classes.
Well said. When we return, we'll hear from Travis about portfolio allocation and ways that average traders can invest just like ultra-high net worth individuals. But first, let me tell you how you can become a more informed investor through Early Bird, a free daily email newsletter. Early Bird has commentary on the latest events and trends in stocks, cryptocurrency, and crowdfunding. With Early Bird's daily weekday email, investors can quickly stay on top of the trends and beat the market. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, back to today's discussion. So, Travis, today we're talking about where the ultra-high net worth are investing, and you brought up the private markets where most ultra-high net worth individuals tend to gravitate towards, especially in the last few years, especially the past year, given the state of equities for sure. I want to shift the conversation now to retail investors, individual investors out there who are not ultra-high net worth. There have been a lot of platforms the past few years that have opened those private asset classes to retail investors, whether it be private real estate or equity crowdfunding that allows average investors to invest in startups. What do you think about these platforms out there that have sort of democratized, for lack of a better word, the private market investing world for retail traders?
I think you've actually hit the nail on the head. We hear a lot about the democratization of private assets, which is great. The reduced liquidity and typically more accredited type profiles, higher net worth investors like you described, kind of kept this asset class to that community, and they benefited from it for the reasons I described: reduced correlation, reduced volatility, higher yields. And it's in a lot of ways it's left the mainstream investors out. So with the advances of technology, more friendly regulation on it, as there's more oversight into these areas, larger institutions are more willing to pick them up and make them more mainstream or retail friendly and give access to that mainstream client. I think it's perfect. The high net worth community has benefited from this for decades, and the faster we can educate mainstream and not only just the client, but the firms that are offering it to the client, the better off everybody's going to be, because the secret's out. Private assets are you need to be allocating to for the portfolio construction.
Absolutely. It's definitely, for most investors out there, including mainstream investors, should be looking at alternatives, the private markets. You talked about a lot of the advantages, Travis, and as well as the disadvantages of maybe alternative investing. It's not as liquid as the public equities tend to be. I know I'm not a financial advisor. I always tell listeners to the podcast, please speak to a financial advisor before making any investment decision. But generally speaking, when you're talking about average investors, what kind of portfolio allocation are we talking about for private markets? Are we talking about a high percentage or a much lower percentage?
And that's a great question, Stephen, but it really comes down to the old cues that we would normally take. So what's the risk tolerance of that particular person? And what's the time horizon of this investor until they need the money? So different, and the reason being is because of that illiquidity that comes with it, they're in a lot of ways they're deemed more risky of an asset class, even though they're not, just because of that liquidity. The investor can't go get that money in an emergency situation, or in an opportunistic situation overnight. They'll have to wait that 30, 60, or 90 days. But as long as that's communicated clearly with the investor, they have the appetite for risk and the tenure for liquidity, then I have no problem trying to get a mainstream investor up to a truly institutional allocation. And when you get those allocations, typically will range anywhere from between, say, 30 upwards of, say, 50% or more in private assets. Now, over 50 might not be right, but it's certainly 30 to 50. And the reason why I say that, if you look at south of the border, Arizona state retirement system has over 50% in private assets, and north of the border, Canada Pension Plan, the same. So clearly these institutions have longer time horizons, but if you diversify heavily and can build liquidity into your private portfolio, sure, 30 to 50% would work.
Got it. It really depends on the person's risk tolerance. You brought up a great point there. So, Travis, I wanted your advice. Let's say, I'm an average retail investor and I want to invest just like the ultra high net worth individuals out there. I have two options. I could either A, win the lottery, become a billionaire and invest like them, or B, I'm sure there are other options for average investors to invest like the ultra high net worth in the private markets. What advice would you have for average investors who want to get started in that type of investing?
So I think, the real challenge is education, right? So, and it's not only, you got to go find an institution and advisors have specialty in this area. Mm-hmm. Our institution, Harbourfront Wealth Management, definitely one of the leaders in private asset allocation in Canada. And then, of course, finding an advisor at Harbourfront, close to you would definitely be accommodating to that investment wealth manager experience. So no matter, and that would be in Canada or in the United States, but definitely a firm that has, more than one private asset approved on their product shelf. You want to be able to diversify that counterparty risk. Okay. Lots of options through diversification. And just you're going to have to find the right firm that has that experience, and then create a relationship with an advisor from there.
Well, good advice. Travis, thank you so much for coming on the Early Bird podcast today, talking about where the ultra high net worth are investing and about everything we need to know about the private markets here in 2023. Before we wrap up the episode, I just have one final question, and it's the most important question for today's discussion. That question is, if you could see one movie again for the first time, what would it be and why?
One movie again for the first time?
Mm-hmm.
That's an interesting question. One movie again for the first time. And does it have to be education-based or entertainment-based?
Anything, any movie.
I'm going to go with Christmas Vacation because it's the holidays and it's always fun to be around the family in the holidays.
Good choice. Thank you again to Travis Forman for sharing your insights on investing. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.